Hey everyone! Looking for a stable, reliable way to grow your money? Bonds might just be your new best friend. In this video, we'll cover everything you need to know about bonds, what they are, how they work, and why they're an essential part of many investment portfolios. By the end, you'll feel confident taking your first step into bond investing.
Welcome to Novice Investing Guide, all you money makers. Today we are going to explore the exciting adventure that is bond investing. Before we get going, do you own any bonds? Savings bonds, treasury bonds, I-bonds? Let us know in the comments below and stick around for some helpful bond investing tricks. Think of bonds as IOUs. When you buy a bond, you're essentially lending money to a government, corporation, or organization. In return, they promise to pay you interest over time and return your money on a specific date. Bonds are often viewed as a safer investment compared to stocks because of their predictable income.
Every bond has three key components: face value, the amount you'll get back when the bond matures; coupon rate, the interest rate the bond pays annually; maturity date, when the issuer pays back the loan. Understanding these basics is crucial, but not all bonds are the same. Let's explore the different types of bonds.
There are four main types of bonds you'll encounter. Government bonds are issued by a country's government to raise funds for public projects or to finance government operations. These are considered among the safest investments because they are backed by the government's ability to tax its citizens or print money. Some features of these bonds are: low risk, as default is rare for stable governments. The return is expected to be moderate. Lower risk means lower return. Tax benefits in the U.S. Treasury bonds are exempt from state and local tax. There are a few subtypes of U.S. government bonds. Treasury bills, T-bills, are short-term bonds that mature in less than a year. Treasury notes, T-notes, are mid-term bonds with maturities of 2 to 10 years. Treasury bonds, T-bonds, are long-term bonds with maturities of up to 30 years. Treasury inflation-protected securities, TIPS, are bonds that adjust for inflation. Investors seeking stability and preservation of capital, such as retirees, should look into these bonds.
Second is corporate bonds are bonds issued by companies to fund business operations, expansions, or acquisitions. They typically offer higher returns than government bonds, but carry higher risk. Corporate bonds vary in risk depending on the company's financial health. The return is higher than government bonds and is based on the risk. Some pros are potentially higher returns and a variety of choices across industries. Some cons are increased risk and vulnerable to economic downturns. Bond investors comfortable with moderate risk in exchange for higher returns should research these types of bonds.
Third are municipal bonds, which are issued by state or local governments to finance public projects such as schools, highways, or utilities. Municipal bonds offer tax benefits as interest is often exempt from income taxes and sometimes state taxes. The risk is typically low depending on the municipality. Return is again linked to risk, lower return. Some pros are tax advantages, especially for high-income earners, and helps to support your local community. Some cons are lower liquidity than US bonds and can be risky. High-income earners looking for tax-efficient investments should look into these investments.
And fourth are high-yield or junk bonds. These are bonds issued by companies or entities with lower credit ratings. They offer higher interest rates to compensate for the higher risk of default. These bonds are often issued by newer companies or businesses facing financial trouble. The return can be high as compared to other bonds due to the increased risk. Pros are the potential for higher income and diversification for aggressive portfolios. Some cons are there is a higher than normal risk for default and are sensitive to economic downturns. Experienced investors with a high risk tolerance and a desire for potentially high returns should check into investing here. Your choice of bond will depend on your financial goals, risk tolerance, and how long you're willing to keep your money invested. Bonds generate income in two main ways. Interest payments, coupon payments, is the annual interest the bond issuer pays you, typically on a regular schedule, and capital gains. If you sell your bond before maturity, you might profit if its market value has increased. While bonds might not have the explosive growth potential of stocks, they're a reliable source of income, especially during uncertain market conditions.
Like any investment, bonds come with risks. Here are 3 key ones to watch out for. Interest rate risk. When interest rates rise, bond prices typically fall. Credit risk. If the issuer defaults, you might lose your investment. Inflation risk. Over time, inflation can erode the value of your bond's fixed interest payments. The good news? Researching the issuer's credit rating and diversifying your bond portfolio can help mitigate these risks.
Ready to start investing in bonds? Here's how. Choose a platform. You can buy bonds through brokers, investment apps, or directly from the government. Set your goals. Are you looking for steady income, or do you want to preserve capital? Diversify. Mix different types of bonds to balance risk and reward. Now you know the basics of investing in bonds. Whether you're seeking steady income or a way to diversify your portfolio, bonds can play a vital role in your financial journey. If you found this video helpful, give it a thumbs up, subscribe for more beginner-friendly investing tips, and drop your questions in the comments below. Check out our other videos, and we will see you next time on Novice Investing Guide. Thanks for watching and happy investing.